All right, let's get started. Hi everyone, thanks for making time to join us this evening to learn more about investing in Chinese government bonds. Let's get to know our panelists for tonight. First, speaking at tonight's webinar is Bruce Zhang, a fixed income portfolio manager from CSOP Asset Management. Bruce is based in Singapore and he does the strategies for the bond investments in CSOP. Prior to CSOP, Bruce has worked at State Street Global Advisors and held several roles which focused on product development and portfolio management that involves managing billions of dollars across Asia local currency bonds, onshore China bonds, Asia credit, and more. So next, we have Vivek Mohindra, who is Kristal.AI's co-founder and chief responsible officer. Vivek is based in Hong Kong and has over 20 years of experience in trading and investing in Asian credit markets, including complex and structured products. He is also a popular speaker and the most viewed finance professional in Hong Kong on LinkedIn. In this webinar structure, feel free to use the Q&A tool to ask our panelists questions anytime. And if you have other questions relating to the topic outside of this webinar, you can email to us at support@Kristal.AI. Do note that this webinar is being recorded and will be uploaded to our official YouTube account after the session. It is important to know that the information and discussion in this webinar is meant for general reference and not an investment recommendation. Lastly, if you're interested in learning what we covered in our previous webinars and stay connected with our latest updates, please subscribe to Kristal.AI's YouTube. Now, let me hand over the time to Vivek for him to take us through investing in Chinese government bonds.
Hi, everybody. Let me just share my screen first. Okay, is that... Okay,
yes,
is that clear to everybody? Okay. Actually, yeah, thanks for the introduction, Hilda. Yeah, what we're going to do today is, cover some of the aspects about the China government bonds. It's quite interesting that, this is one of the unexpected effects of the COVID-19, I would say. There was never so much focus on Chinese government bonds earlier, but after the COVID-19, because of a variety of reasons, in the last 6 months, definitely we've started looking at it. What I'm going to say is, I'm not going to cover this in detail. There's another YouTube video you can look at about how we do portfolio allocation. So this is about the theory of portfolio allocation. But what I just want to point out is that when we allocate our clients' investments, we always allocate it between fixed income and equity. And we use traditional theories. These are very old theories. The fixed income portion is generally allocated towards either investment grade or sovereign bonds. You can see it says diversified to uncorrelated asset classes, and so far we've been doing it into US Treasuries, primarily because US Treasuries used to be very uncorrelated, and there's a proper ratio. In fact, 1% change in equity leads to a 2 basis point change in US Treasury. Just giving you a couple of examples of the algo results. As you can see in the last, I just ran it yesterday. So you can see that the recommended crystals or the algorithm recommends a portfolio which has some 20-year Treasury bonds, US Treasury bonds again, and in another portfolio again, some 3 to 7 year US Treasury bonds and 20-year Treasury bonds. So what I wanted to kind of make clear is that our existing portfolios definitely have an allocation to US Treasury bonds in order to reduce the risk in the portfolios and improve the Sharpe ratio, i.e. improve the overall performance and reduce volatility. Now, what's happened is these correlations, etc., have changed. You might have noticed that the interest rates in US have come down significantly. So, whether we look at it a little bit later also, but 5-year, 10-year treasuries are, down to below 1%. The fundamentals have changed quite a lot. The US has basically spent $3 trillion of stimulus money and is planning to spend another $2 trillion of that. The political situation in US is also very uncertain right now because of the forthcoming elections. But the biggest, of course, thing for us is the correlation changes and the fact that US fixed income portfolio may not hedge yourself against bad volatility in equities. And that's one of the things that concerns us as portfolio managers, and especially our algorithm is very concerned with that. On the other hand, there has been some positive developments on the China government bond side in terms of inclusion and market opening up, which I'll just cover. So this is what is basically leading us to look at China government bonds in detail, and which is why I've invited the expert from CSOP. And interestingly enough, they've also launched the fund, as he will explain to you, just recently, which kind of goes with this whole theme of why China government bonds are important right now. As I mentioned, the thing about correlation, China government bonds are actually uncorrelated with very low. On the right hand side, you can see there's very low correlation with even US treasuries or UK treasuries, Japanese, and so on and so forth. So while within themselves, US, UK, Japan are quite highly correlated, as you can see, 71%, 55%, and so on and so forth. China is relatively uncorrelated with other government bonds. And on the left-hand side, you can see that there's a very low amount of correlation, even with other asset classes, high yield credit. In fact, even with China, even with Chinese bonds quoted offshore. So Chinese onshore versus Chinese offshore are also very low correlation. And what we're going to look at today is mainly Chinese onshore bonds, i.e., denominated in CNY. So just to bring that into perspective. So that asset class is definitely seems, as per these charts, seems very uncorrelated with anything else, and that gives more power to our algorithm and the portfolio that we suggest. Now, fundamentals, as you're aware, that China's recovered. I mean, people have been posting photographs on WeChat about clubs are doing well, people are out drinking. The Golden Week, everybody was out on a holiday, etc. But even otherwise, if you look at some of the fundamentals, while the China rating is worse than the US rating, the debt to GDP ratio for 2021 is going to be significantly lower. The fiscal deficit is going to be significantly lower. The bond market, of course, is much larger in the US. But look at the comparison in 10-year treasuries. And that also is something which we need to keep in mind ultimately, because we're looking at some returns. And of course, the trade balance, despite all this talk about US trade, dispute and etc., the China trade deficit has really not been impacted. It's still about a 50 billion. I'm talking about global trade balance. It's 50 billion per month, and US trade deficit is about 50 billion negative per month. I'm not just comparing the versus US versus China, but overall. So if you look at these fundamentals, China has definitely started looking much better over the last 6 months compared to the US, just because of the amount of money that they've printed in the last 6 months. At this point of time, I'm also going to launch a poll question. Hold on. Let me see. I'm going to launch a poll question. Something is. Stop the sheet scanning and launch a poll. Which sovereign bond do you think is the most attractive to you? And I would request you to kind of like put this up on please respond to this poll. And meanwhile, I will just also share at the same time one slide which I'm just trying to pull up here. Yeah, this is just for your information, just to compare them, so that to help you make a easy decision. So these are the various countries. Look at the ratings and look at the 10-year yields, right? So look at US versus China versus Germany's negative yields. But also please consider currency appreciation. Because when we're talking about this, we're talking about local currency bonds. So as you may be aware, that the US dollar has been relatively weak in the last 6 months, while China yuan has appreciated quite a bit. Euro has actually also appreciated, and so has the yen. But the yen yield is almost 0%. And when I mean other A-rated sovereigns, I'm looking at Hong Kong, Singapore, which are AA plus, and Singapore is AAA and gives you 0.89%. So that one. Japan is A plus, which is same as China. Okay, so from from whatever responses have come in, well, China seems most attractive, which is not surprising because many of you are obviously watching this webinar because you're interested in China government bonds. But that kind of seems to indicate that. I'm going to end the polling now. Okay. And then share the results. Okay, there you go. Okay. So yeah, China was the number one there, and I will stop this. Okay, so that was the poll question. Yeah, as we saw in that slide, actually the yields are basically gone below 2% overall. If you look at the entire global market of bonds, 40% of the bonds which yield more than 20% are in China. Only 28% in US, 18% in other developed markets, and of course, 8%, 8%, 8%, and 6% in emerging markets and Asia ex-China. So if you really want yield in the current environment, you really have to focus a little bit on local China government bonds and local China bonds. The other thing on the graph, which you can see on the right-hand side, is the impact over the last 3 to 4 months. As we all aware that in March there was a severe volatility in all risk assets, and almost everything went down 10 to 20%. If you can see the red line, the China government bonds actually didn't go down at all. I mean, they went down a little bit, but they kind of recovered quite quickly. So if you wanted something which was less volatile, you would have definitely, this offers some safe haven, as you can see from this slide. I'll mention the recent changes. Barriers are coming down. Amazingly enough, that the big change, which is the last 3 lines of the red, happened only literally 2 weeks ago. They've combined QFI and RQFI quotas. There used to be quotas, and that's applicable from November 1. Many of the limits are gone. They've linked interbank and exchange markets. Earlier, they had, they've been kind of liberalizing over the last 20 years with QFI in 2002, RQFI, the renminbi qualified scheme in 2011, Bond Connect in 2017. But it's been very slow and steady. And now they've done a big move in terms of the changes. They've also removed the hedging requirement on futures, and that will have a big impact on how you can actually hedge your exposure onshore in China. So a lot of these changes happening, and this is it's hot off the press because it's only happened in the last like 2-3 weeks. Okay, indices, yes. China was already getting added to the Bloomberg index and the JP Morgan index, and now it has got added to the FTSE index, WGBI index in the last, again, 2 weeks ago, and this will happen over October 2021. And these are all relevant because all of them will mean that there is more flows coming in. Foreign holding of Chinese government bonds has been increasing month by month. They've been more inflows in almost every asset class. So if you can look at, it's not just government bonds, it's also in loans, deposits, equities. So you can see that there is money flowing into Chinese assets. And this will obviously have some tailwind because this will lead to an appreciation in some of these Chinese assets. Some of these things which I'm covering actually are also, there's a correlation with what Bruce will cover. So, he can expand on a little bit of more detail. So I'm going to leave it at this point of time. There are some more things, but the basic thought is that the last 6-12 months and the impact of COVID has not just been in terms of our lifestyle, in terms of our stay at home, in terms of working with Zoom, etc., and having webinars. It's also had some fundamental economic impact in terms of where we will invest, how to allocate our portfolios, how the correlations between different markets are, and all those things. So we have to kind of change accordingly, change how we live, change how we invest. So both. I'm going to pass it off to Bruce now, and then we will also please feel free to give out your questions, and then we'll try and answer them as we get along.
Thanks, Vivek, for sharing your deep insights on the market. Now let's give the time to Bruce to share with us his understanding on the Chinese government bonds.
Thank you both. So in the next 15 minutes, I will start with a quick company introduction, followed by why investors should consider onshore China government bond investment and index inclusion, in particular in the form of the ETF. And first of all, the CSOP is a China investment export, and also an ETF leader. Returning to page 4, our firm is established in 2008, and as of August 2020, our firm has an AUM of $8.5 billion. And our major shareholders include China's Southern Asset Management Firm, as well as the Huatai Security Firm. As an ETF leader, the CSOP has listed lots of ETFs in Hong Kong, including some top actively traded ETFs in Hong Kong. We are also committed to developing our business in Southeast Asia. For example, we are the first Chinese asset manager opening office in Singapore. We are also among the first batch of asset managers to launch VCC framework in Singapore, and we are also the first manager to issue the VCC ETF. And in the second session, we believe the strategic case for onshore China government bonds is supported by its attractive yield and strong sovereign quality. Turning to page 8, I believe Vivek also covered some of these parts in his presentation. It is very hard to search for yield now in a low growth, low rate world. But if you look at the bottom left chart, the Chinese government bond 10-year yield is over 3%, or at least 300 bps plus against most G7 countries. And also, it has a very strong local sovereign rating at A+, which is comparable to Japan, and it has never defaulted in the trackable history. And historically, the onshore China government bonds, or the onshore CGB, had a very attractive return risk ratio as compared to major developed markets government bonds, for example, against the GBP or against the Euro, as well as the JPY government bonds. It's also worth noting the China government bonds US dollar return volatility is also much lower than these major peers, almost half over the past 10 to 11 years. And if you compare this, the return risk ratio against the US Treasury bonds, we found that the China government bonds return risk ratio is slightly lower than the US Treasury in the history, but it's worth noting that the US Treasury return in US dollar definitely not subject to the FX volatility. And if you look at the first row of this return table, we can see the China's government bonds yield has a much higher yield against other major peers on a weighted average basis across curve. This means the potential yield pickup opportunities may not only be limited to the 10-year tenor, but across the curve. And also, if you look at the second table, it had a very low correlation in the history against the major DM peers, in particular against US Treasuries, which is just around 0.07. And nowadays, China's bond market is too big to ignore. And now it is the world's second largest bond market, with the outstanding bonds arriving at $15 trillion. But on the other hand, the foreign investors just only own around 3% of the onshore China bonds. If you look at the chart on the bottom left, here the larger the bubble means the larger the bond market size, and the lower the bubble means the lower the foreign shares. Then, as China continues to open its capital market, we believe China still has room to attract more foreign money. And since the onshore CGB is denominated in renminbi, it's worth to check the renminbi near-term outlook. If you look at the chart 1 on page 11, currently China started to recover from the negative impact of the COVID-19 with the more prudent monetary policy, while the United States still struggled to fight against the virus with the zero-rate policy stance. So all else equal, this should continue to support renminbi against the US dollar. In fact, if you look at the chart 2, China managed to run large trade surplus in recent months, thanks to the strong government support on the supply chain, as well as the reduced demand from the energy, as well as the outbound tourism. In addition to the current account, if you look at the chart 3, in terms of the financial account, the accounts also benefit from the large China-US interest rate gap, And now the 10-year yield spread is still at historical high. And this also partially explains why the foreign money continues to flow into the onshore China bond market, as shown on the chart 4. And looking ahead, in the short term, we believe a more prudent or neutral policy stance would have a negative impact on the China government bonds price return in RMB. But we have to say, after 4 or 5 months yield pickup, the market has pretty much priced in this more neutral or more prudent monetary policy stance from the PBOC, which means this impact will be towards to neutral. But on the other hand, the coupon return, the coupon advantage still in place, and the fundamental resilience on the renminbi would still net contribute to the total return of the onshore China bonds. And in the long term, we believe finally the China growth will be slower or mature, which means the bond price in renminbi will benefit from a lower yield environment in the future. But this relative coupon advantage will only diminish gradually because of the relative growth strength against major peers in the world. And the renminbi should still get some support if China continues to consolidate its position in the global growth picture. And also, despite the negative impact of the COVID-19, year to date, actually I have September data, the China government bond index return, as represented by FTSE CGBI, gained 3.8%. Among these, 2.3% is from the renminbi appreciation, and the balance of 1.5% is from the renminbi total return, mainly driven by the high coupon. And in the third session, we believe onshore China government bonds will benefit from the current index inclusion, as these inclusions will potentially bring large inflows into this sector. And actually, on page 14, the CGB has been included in the Bloomberg Barclays Global Aggregate since April 2019, and JP Morgan also started including CGB into its flagship GBI EM indices starting from February 2020. And just 2 weeks ago, the FTSE Russell just announced that CGB will be included in its flagship Week B index, with the inclusion scheduled to start in October 2021. And if all these 3 major index vendors finish their inclusion, it should, in theory, bring around $320 billion inflow into the onshore China bond market, with FTSE Russell itself accounts for around $150 billion. And actually, the foreign institutions, or at least some of them, already moved ahead before the index inclusion. And as of August 2020, they held over $400 billion of onshore China bonds, or over 4 times of the amount as compared to 2015. And page 16 gives us a snapshot of the FTSE Chinese government bond index information, which is also the benchmark of our ETFs. And here, as compared to its major peers' flagship China bond indices, we believe the FTSE CGBI provides an exposure to pure CGB bonds, and it also seeks for balance between the representativeness and liquidity. For example, it captures the CGB exposure between 1 to 30-year tenor, as well, and with a high minimum entry threshold at CNY 35 billion per issue. This means this will kick out some illiquid bond names with small issue size out of the index. And in the last session, well, we believe some foreign investors already have existing channel to directly invest in onshore China bonds. We believe the ETF still makes sense in terms of the liquidity and cost. And slide 18 is a snapshot of our China government bond ETF information. And with the AUM over $700 million, and now the ETF is the world's the largest pure CGB ETF. And we also have a large, diversified, and relatively stable client base, including sovereign wealth funds, endowments, family offices, international banks, and large institutions. And these enable us to obtain sufficient bonds to track the index closely and also increase our negotiation power when trading the underlying bond. And the investment objective is to track the benchmark as closely as possible using a sampling strategy. And the base currency is in renminbi. And on the secondary market, we have the SGD and USD counters available to investors. And in terms of primary application, we have the renminbi and US dollar available for investors. And the entry threshold is quite low. For secondary market, it starts at around US dollar 100. And for primary application, it starts around 500,000 US dollar. We believe the ETF vehicle makes sense to retail investors or even the high net worth investors because, for example, for a single CGB bond, the trading size in theory starts at 100K in RMB. Sounds not that large, but actually the liquidity will only become good when the trading size starts from RMB 10 million. So an ETF with starting points at around US dollar 100 definitely could benefit those retail and high net worth investors. But even as for institutional clients, nowadays it still takes time and effort for them to register for the onshore China bond access. So an ETF with an existing investment channel with the options to trade primary or secondary and with the transparency and liquidity definitely provide a one-stop solution for both the institutional clients and retail clients. And also, our ETF's total TER is just 25 bips. I think this is very important because in the most cases, if without the underlying liquidity access, it will be more expensive to trade a similar basket of underlying bonds as compared to buying the ETF directly. And comparatively, our ETF will leverage our dedicated onshore China trading desk, our broker network, to check the bond price against 10 plus major counterparties to seek for the best execution for the underlying bonds for our clients. And the ETF will mainly consist of the most liquid underlying bonds and the relatively liquid bonds. These will also help the ETF's product liquidity indirectly. And lastly, we use the sampling approach, which means we just select several cash bonds divided into major maturity baskets. This is because despite the recent years' liquidity improvements for onshore China government bonds, the whole universe liquidity still diverged. So when we consider increasing the number of bonds here, we'll seek for a balance between the tracking error contribution as well as the liquidity to ensure that the trading cost will not overwhelm the potential benefits narrowing the tracking error and also reduce the unnecessary underlying bond turnover. And now the ex-ante tracking error is expected to be within 20 bips for the product. And I'll pause here to see if any questions. Thank you.
Okay, thank you, Bruce, for this enriching presentation. Now I have a few questions for our panelists, and I'm sure the audience also have some burning questions to know from the both of you. So question to Bruce, could you share with us your experience with this Chinese government bond index ETF so far in terms of demand flow of the Singapore dollar and US dollar, as well as the trading bid offer?
Sure. Actually, we do see a very strong demand even during the IOP stage. For example, before the launch of our ETF, we have already locked around US dollar 676 million in US dollar of AUM. And after listing, we continue to see the strong primary demand of around US dollar 15 million in the 1 week and a half after listing. And in terms of the secondary trading, we also see some strong demand from both the US dollar and SGD shares. And right after listing, the bid-ask spread is around 1% or around 10 bips in a relative basis. And nowadays, it becomes a bit wider, but it's also well within our expectation because now China is on Golden Week.
Thank you, Bruce. And next question I have is for Vivek. Could you share with us your perspective on any future trends on Chinese government bonds investment? And where do you think the appreciation will come from?
Thanks for that, Hilda. Yeah, actually, I think Bruce also covered it in, I think, one of his slides. So the returns are comprised of 3-4 different things. Because now we're looking at CNY onshore government bonds. So one is, of course, the currency itself. As he pointed out, most of the gains this year have come from the appreciation in the currency, the renminbi appreciating against the US dollar. He mentioned 3.5%. In the future, also, I expect the yuan to definitely appreciate and give returns of 3 to 5% over the near future, just because of the relative fundamentals of each of the countries, US versus the Chinese economy at the current stage. So that may give another 3 to 4% of returns. The second is the coupon itself. The coupon is about 3%. So you will definitely get 3% return per annum in terms of coupon. The third thing is in the appreciation of the bond price. As we saw that globally, almost all bonds are literally between 0 to 1%. And even the European bonds are effectively below, are in negative yield territory. As a result, I think over the 3 to 5 year time horizon, over a longer term time horizon, I don't see any reason why Chinese government bonds will also not move down the graph to to basically 1 to 2% levels. As the capital flows become larger, as the foreign ownership of Chinese bonds increases, definitely it will get pushed down. So there could potentially another 1 to 2% benefit from appreciation in the price of the bonds. So altogether, I personally, this is again not a company view, but personally, I would think that you could expect between I think 4 to 6 to 7% return. And the more important thing to note also is from the Kristal perspective and from the portfolio allocation perspective, this is a low correlation asset class, very very low risk, sovereign. I don't think China is really going to default on domestic yuan obligations. So it provides a balance to your portfolio when you're investing in equity on the one side and high yield assets on the high yield, high risk assets on one side. So you have to balance it between the and this is why we're recommending this. I also want to ask Bruce a couple of questions that have come. So one question was I just covered. What is the likelihood of default on China government? Is it possible?
Yeah, sure. Actually, as I mentioned, it has never defaulted in the trackable history. And also, it's important to note, it's very unlikely for a government bond to default, in particular for the government bond in local currency. And also, this bond credit quality for now, so we are quite confident that China government bonds will not default in the foreseeable future.
Right. Yeah. Yeah. I kind of agree with that. Yes, I think so.
Yeah. Maybe I also try to answer why is the ETF listed in Singapore instead of Hong Kong or the United States. Actually, I would believe that both, for example, Hong Kong and Singapore, they have room to develop its fixed income ETF market. But as compared to Singapore fixed income ETF market, actually the Hong Kong ETF market, although it has a larger size, it's dominated by one bond ETF, which is the Asian bond ETF. And the other ETF, most of the other bond ETFs are actually concentrated in the renminbi bond ETFs. But comparatively, Singapore has developed a well-established Sing dollar and US dollar ETF, bond ETF markets across different sectors. And we believe a China government bond ETF with a local relation to these existing ETFs can be a good supplement to Singapore ETF market. And also during this launch of these ETFs, we also get strong support from the Singapore regulators and institutions.
Okay, thank you for that. I'll also try to answer one. There's the simple one, how to buy CGB for small investors. As Bruce covered, you can buy his ETF. But of course, I would also like to point out that there are a couple of other alternatives, not as good as this, but good alternatives nevertheless. There is a UCIT listed in London. It's a CNYB, slightly higher expense ratio by BlackRock at 0.35%. And that one is quite a big ETF, and that one is also liquid and available for smaller investors. There's also a couple of other smaller offerings on the Hong Kong Stock Exchange, but at the current point of time, based on lower expense ratio and a focus on pure government, we rank CSOP quite highly on that on those measures.
Yeah. Yeah, let me answer this question. Does this provide coupons when the ETF is being purchased? Yeah, since the underlying bonds will pay coupons, for example, on the annual or semi-annual basis, and at ETF level will also pay dividends on semi-annual basis.
Oh, that's good to know. So the ETF is going to pay the semi-annual dividend, and they'll be tax-free, right? Based on Hong Kong and Singapore, so no taxes on that, I think.
Yeah, let me answer this. A major risk to CGB investment is that of rapid yuan depreciation on the back of an escalated trade war, at say, with re-election of Trump. How do you see these risks for investors and any mitigation strategies? I would say definitely the geopolitical tensions between the United States and China, for example, in May, will definitely impact the renminbi trend. But from our perspective, we think the bottom line is the trading relationship between the two countries. And since, despite the COVID-19, as I mentioned, China managed to gain some trade surplus, and its import pressure also reduced, for example, from the energy or the outbound tourism perspective, which means it's not hard for China to say absorb the United States request for importing, let's say, the United States agricultural product to China. So from this perspective, we believe as long as the trade relationship, for example, the phase one trade deal is there, I think the renminbi should be stable. And also this phase one trade deal also should be one of the milestones that Trump made for his election.
Okay. There's one question on Chinese government bond issuance in other currencies, euro, Japanese yen, or Singapore dollar. I'm not sure about what their plans are, but of course, Chinese government bond in US dollars is available. But as I showed in one of my presentations, the dollar bonds are relatively more correlated with other risk assets and EM assets vis-a-vis the onshore domestic CNY bond. So in terms of correlation, it's much higher. And therefore, if you're looking to diversify and reduce the volatility on your portfolio, it doesn't work quite as well. And the same would be the case even if they were to do euro, yen, or Singapore dollar issuance. So if you're looking at it more from the portfolio diversification and reduction of volatility point of view, these will not satisfy that objective so well, I think.
Yeah, let me answer this. What turning point should investors look to invest in on the China government bond curve? I think it really depends on the different types of investors. For example, for the pure passive investors, for example, tracking the weekly, or they followed a weekly China inclusion, they definitely will embrace for the full curve from 1 to 30 years. And for some investors, if they don't want the so-called duration risk, they may consider short duration China bonds with still good yield pickup. But we have to note that the long duration, although this may be more sensitive to the interest rate change, over the long term in the history, it still provides a stronger total return because of the high coupon implied.
Okay. Well, there's a question on Evergrande. That's not really the scope of this particular presentation. But I mean, high yield bonds have definitely sold off a little bit, and there are other ETFs that provide for the high yield bond market, and Evergrande has its I think it's a very specific credit related issue rather than overall market related issue or a high yield bond market related issue. So it's, it has something specific, and so we're not really getting into that right now. But we're talking about very high grade sovereign bond issuance right now. Thanks for the question, though.
Let me answer this. The CGB bond holdings, the ETF fund listed outside China called as foreign ownership. In the 3% foreign ownership is inclusive or exclusive of this type of ownership. Here, the 3% solely refers to the foreign institutions outside China.
So that means you also, the ETF would be included, right? So if your ETF buys more of the bonds, then 3% will go up, right? I think, yeah.
Exactly.
Yeah, so yeah, it would, the ETF would counts in this 3%. So this 3%, I think I would expect it to go up to closer to, I don't know what your view is, Bruce, but I think I would expect it to go to 10% within the next 2 years, I would think. What would your view be, and where do you think the ownership will be in 2 years' time, the foreign ownership of China government bonds?
Yeah, I believe as currently solely refers to the government bond ownership, it's already reached the high single digits. I'm confident it would arrive at 10%.
Thank you. I think, yeah, we are almost at the end. There's a couple of questions if you would like to answer them. I mean, they both are mainly aimed at you.
Yeah, what would be the reasonable premium between government and corporate bonds? I think it really depends. For example, during certain periods this year, we do see the China government bond has a very similar yield versus the AAA corporate bonds in China. But this is here, the AAA is domestic rating. But at least from our perspective, the China government bonds for now still has a very strong quality against the corporate bonds onshore, and also has much more transparency. So once we see a similar yield between the China government bonds versus corporate bonds, then definitely I will suggest to invest in the China government bonds.
And the last question, you don't really have an ETF in the US, so it's only in Singapore. You do have some ETFs in Hong Kong, but those are slightly different. So how would you compare your ETFs in Hong Kong versus Singapore, let's say? You don't have anything in US, right?
Not for this renminbi bond perspective. For example, we do have one renminbi bond ETF in Hong Kong, which tracks the Bloomberg Barclays China Treasury Plus Policy Bank Index. But we only changed this benchmark to the Bloomberg Barclays since mid last year, and we believe to be for China government bond ETF to attract more inflows, it needs a big start size. A big starting size means that we can obtain sufficient bonds, means we have negotiation power when trading the bonds. It also overcomes some obstacle for the large institutions because most of them have a investment limit, for example, 10% into the fund. So since we have a large starting size in Singapore, then we're confident we can attract more inflows into the ETF here.
Okay, Bruce, I think with that we've kind of answered all the questions today, so that's quite good. I think people should be quite happy that we've been able to answer everything. Anything else, Hilda?
Nothing else from my side, and it's been a really insightful evening having both you and Bruce to share about Chinese government bonds. So everyone, for more information on the Chinese government bond index ETF, do download our Kristal.AI app or visit our website at www.kristal.ai and explore the product section. Thanks everyone, have a great evening.
Thank you.
Thank you, Bruce. Thanks everybody.